you ever wonder what really makes a business tick? I mean, forget all the flashy marketing and the big shot strategies for a minute. Deep down, there's a universal language, one that every single business, from the tiniest startup to a global giant, has to speak fluently. That language, my friends, is accounting. And today, we're going to break down its most fundamental rules. I know, it sounds a little crazy, right? How can a local spot selling lattes and a massive tech company launching satellites possibly play by the same rulebook? Well, what they have in common is a set of principles they use to measure success, to check their vitals, and to tell their financial story. And that's the whole secret. They're both operating under the exact same core concepts. It's kind of the great equalizer in the business world. So, you know what? Let's start our own little coffee stand right here, right now, and learn this language as we go. Okay, first things first. We've decided to open this coffee stand. You put your own hard-earned money into it, so are you and the coffee stand basically the same thing? Well, in the eyes of accounting, the answer is a huge, emphatic no. This right here is the absolute bedrock of all accounting. Think of the business as its own person. When the coffee stand buys coffee beans, that's a business transaction. But when you go buy groceries for dinner, that's a personal thing. You've got to keep them separate. The business has its own life, its own bank account, its own story to tell. And what's so cool about this is that the rule doesn't care if you're big or small. It doesn't matter if you're a one-person show, that's a sole proprietorship, or a massive public company with thousands of investors. This first commandment always applies. The business is its own thing. So why do we care so much? Well, this isn't just about keeping tidy books. This separation creates a legal and financial firewall. If, heaven forbid, the coffee stand gets into some financial trouble, your personal car, your house, they're safe. This one concept is what gives people the confidence to even take a business risk in the first place. All right, so our coffee stand is its own person now, but how do we write down its story? How do we record everything it does all day? Well, there are a few key rules for how we track every single move it makes. This one's pretty simple, but it's really powerful. In the world of accounting, if you can't put a price tag on it, it doesn't get written down. That amazing can't live without it vibe of your coffee shop, not in the books. The incredible skill of your head barista, sorry, not in the books. The $500 you spent on coffee beans, oh yeah, that definitely goes in the books. Okay, let's say you buy a shiny new espresso machine for $3,000. That's its cost, and that's the number that gets recorded. Now, even if a year from now it's only worth $2,000, or maybe some collector thinks it's a vintage classic worth $5,000, it doesn't matter. You keep it on the books at its original historical cost. It just keeps things objective and based on facts, not opinions. Now we're getting to the absolute heart of bookkeeping. Seriously, think of it like a law of physics. For every action, there's an equal and opposite reaction. Every single time something happens in your business, it affects at least two things. There's always a get and there's always a give. And look at this. It makes perfect sense when you see it laid out. A customer hands you $5. Your business gets cash. At the exact same time, it gives a cup of coffee. You buy that new espresso machine. The business gets a machine, but it gives away cash to pay for it. See? This two-sided dance is the engine that makes all of accounting work. Okay, we've got the rules for recording every single play. But how do we add it all up to see if we're actually winning the game? We can't just look at the business's entire life all at once. To really understand if we're doing well, we have to break the game into innings, or periods. We need a way to keep score. This is the question every single business owner on the planet asks. Was January a win? How do we do in the first quarter? To get an answer, we need to be able to chop up time into little bite-sized pieces. And that's exactly what this concept lets us do. We're essentially creating chapters in the story of our business. And at the end of each chapter, whether it's a month, a quarter, or a year, we can pause, take a snapshot, and run reports to see if we made a profit or a loss during that specific time. Okay, pay attention because this one is a biggie. Let's say you cater a big office party in December, but they don't actually pay your bill until January. Well, under the accrual concept, that income belongs to December. Why? Because that's when you earned it. It has nothing to do with when the cash actually landed in your bank account. And this concept goes hand in hand with the last one. To figure out your real profit for December, you take that catering revenue you earned in December and you subtract the costs it took to make it happen in December. Things like the coffee beans, the milk, the cups you used for that party, you have to match the effort with the reward in the same time period. This is so crucial because it gives you a true picture of how profitable you were that month. Now, you might hear some people talk about a simpler way called cash accounting, where you only record things when money actually changes hands. But honestly, for getting a real accurate picture of a business's health, it's almost never used. The accrual and matching concepts, that's what tells the true story. So, we've covered a whole bunch of rules, but there's one last principle that basically holds the entire system together. It's the concept that makes sure the numbers aren't just, made up. It's what makes the whole thing trustworthy. I like to call this the show me the proof roll. You say you spent $3,000 on that fancy espresso machine? Great, show me the invoice. You say you made $500 in sales today? Awesome, show me the report from the cash register. Every single number that goes into your accounting books has to be backed up by a piece of objective, verifiable proof. And this quote just nails it, doesn't it? This whole principle is what makes accounting a reliable language. It makes sure that the financial story your business is telling is nonfiction, grounded in cold, hard facts. It's how you build trust with banks, with investors, and most importantly, with yourself. So there you have it. From treating your business like its own person, all the way to proving every single transaction, you now get the fundamental grammar of business. These aren't just random rules. They are the principles that let us build, measure, and truly understand any business out there. You now speak the language. So the only question left is, what story will you tell?